the old disconnect between economics and the market. So can the market be wrong? So I always say the market can fib, but it doesn't lie, and it certainly doesn't get away with it. So it can certainly lead you astray at times. I think that we try to mitigate that risk is by looking at the weight of the evidence of a lot of different things, right? So instead of just looking at, say, the S&P or bond yields or any of that, we try to dig down into what's going on and then look at those relationships historically. And, one that we mentioned before is the cyclicals outpacing the defensive names, right? And that's important because that implies that they're that part of the market's not seeing a problem with aggregate demand as we look out the next 6 to 12 months.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
All right, welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is Friday, September 12th, 2025. I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
All right, Neil, who you want to piss off this week, globally?
You need to travel to Antarctica sometime.
I would like to see President Trump come to more Yankees games so we can beat on the Tigers.
Yeah, that wasn't great. That wasn't great. I was there the night before. I didn't realize Trump was gonna be in town. I was gonna actually go last night, and then they were like, "Hey, if you're coming back tomorrow, you should be here by 4 p.m." I'm like, "For a 7 o'clock game? Yeah, security's gonna be tight." I'm like, "Nope, no, thank you."
He's been coming to a lot of New York sporting events. He was at the U.S. Open.
So I will say on it would have been Wednesday night. I was surprised. They had Charlie Kirk. They put a picture of him up, before the national anthem, and to it was actually a nice tribute, like done very, very, very last minute. But the reception was surprisingly warm for New York. But it was a nice tribute.
Oh, it's nice to see that New Yorkers and everybody else are recognizing that violence of any sort is not the right way to go. Whether you believe in somebody's views or not, debate is always good. You got to come to the table and talk, and not this. So, hearts and thoughts go out to his family for sure. Steve, maybe we'll kick it off there. I know it's a weird segue, but does that in any way, what's happened push out the shutdown or maybe bring people together in Washington?
Well, I think that's the hope, is that, this desire to maybe cool some partisan tensions here as a result of what's happened may potentially make conversations a little easier heading into the shutdown showdown. We've had some developments, and I think, there are a couple things that are notable. We have Democrats actually coalescing this time behind a cohesive request, a concession, and that seems to be some demand from Republicans to make some concession here on the healthcare front. One option is to roll back some of the provisions that were included in the One Big Beautiful Bill. I think that's a non-starter. I don't see Republican lawmakers doing that. For nothing else, it would open up a Pandora's box that could potentially lead to other revisions to the bill. They just don't want to do that. So really the issue is going to be addressing these Affordable Care Act subsidies set to expire at the end of the year. And Republicans are divided on this. It's actually a good wedge issue for Democrats to pursue. You have a lot of vulnerable Republicans that want to see some sort of extension. We've talked about this political realignment with a lot of Trump voters now probably more dependent on these subsidies compared to when it was first enacted in 2010. And you have a lot of conservatives that don't really want to see an extension of this policy. And remember, it's not just the Affordable Care Act subsidies. It's the fact that they were expanded during the COVID era. So you took a Biden era policy that expanded an Obama era thing. So, I think what we're noticing here, and this is sort of the great risk that hangs the potential for a shutdown, is the absence of Trump's direct engagement. It's difficult for Republican lawmakers to know what to do without hearing directly from the president as to what he wants. And it's difficult for Democrats to negotiate with Republicans without knowing that. And I think that's the great risk that remains outstanding. That's why I think it remains elevated now. If you look at the betting markets, it still is more likely than not. I don't know that I'm there. I guess what I could see happen, the thing to watch next week is House Republicans are going to put sort of a clean extension for a couple months. I think the date they're looking at right now is November 20th, right before Thanksgiving. And the idea being that can you sort of muscle that through in the House this week with Republican votes only and apply pressure to Schumer to basically concede to that the way he did the last time? Because the public relations war, which really determines whether or not to shut this thing down, how are we going to shut the government down if Republicans give you more than a month to sort of resolve this issue ahead of that December 31st deadline? So I think that's going to be the thing to watch this week. Recall, Republicans were able to do this in March, sort of defied Schumer's expectations. We have a long way to go to September 30th. The threat to shut down the government, again, it remains elevated, but that date might eventually change from September 30th to November 20th. So that's something to watch.
I sort of cut the open off a little bit. Jeff, you're in a new spot. What is that?
This is my podcast room. I actually this is a closet off of my main office, which people are familiar with. But I just turned it into, it's not soundproof, but I definitely have things here that make the sound better, whatever. And I think what's happening today, my wife warned me that the groceries are being delivered, so my dogs would go ape shit when that happened. So I just shoved myself in here. Yeah.
Well, you definitely look just as terrible there as you do.
See, I knew he'd piss somebody off. Just happened to be the boss.
Right. Well, the good news is it's consistent. You look just as bad as you always do.
I'm surprised to hear Pavlik say that the temperature's being dialed down. I mean, I thought the most notable event in DC was that these people couldn't even agree on how to execute a moment of silence for Charlie Kirk.
I said the
on
hope,
the floor of the House.
I
mean, that was sort of interesting. Order in the House. I mean, how many times did Speaker Johnson say that? So I don't know. I'm not as optimistic about any of that stuff. But hey,
Well, that's because your wheelhouse is also the Fed, and we've got a meeting next week, right. And we've got Cook issue. I guess they're trying to get her out before.
Well, that's not happening. I mean, I don't know how this is looking in the court of public opinion, but at the end of the day, she's voting next week. I mean, there's no. I don't think that's a particularly debatable proposition. The thing you have to ask yourself is, is Lisa Cook someone that might have been onboarded for a 50 basis point rate cut, but now because she has the president, breathing down her neck, is she like going to be like, nah, maybe I'll just go for the 25?
Do we know where people stand on that? They don't do it individually, do they?
I mean, you don't know. I mean, you can speculate. It's interesting. I mean, I think it looks like the Senate is fast tracking Myron's confirmation. They want to get it done by Monday, which means that he would be sitting in time for the Wednesday decision. And I don't know how. I mean, it's interesting. It's like having the boss's son at your meeting. If you're around that table, are you going to be like as open? Because look, I mean, at the end of the day, Stephen Myron is a arm of the president, right? Because he is still the chair of the Council of Economic Advisor, which sits in the executive office of the president, right? Like, so it's kind of like, are they going to be as open? Is he there to report back on how the meeting goes to Kevin Hassett and Secretary Bessent? Like, is that why he's there?
Well, wasn't that usually the role of the vice chairman, right? Wasn't that usually a plant or no? At the
No.
Fed? I thought.
No, I mean, the president has a say in who the vice chairman is for some of these, like, supervisory roles and things like that. But, um, like, I don't think, what do you think? Like Philip Jefferson, who's the vice chair of the Fed now, is he reporting back to the West Wing and uh, telling the president and the economic team and and the executive what's going on at Fed meetings? I'm highly suspicious of that. With Myron, I mean, I think that there's obviously more of a chance that can happen, which maybe people hold their tongue. So it's one of these things where I've always likened what's gone. It's like Trump does things that actually push him further away from what he wants, and I think that could be a potential scenario here. And look, the Fed has a very, very difficult look. It's just you have to. It's about being able to persuade people to your point of view, right? Like that's ultimately what this is about. And could I make a case for 50? I can make a case for 50. The unemployment rate is rising. It's been rising a little bit more rapidly over the last few months. Obviously, the pace of jobs growth has slowed substantially. Um, Core inflation is sort of right in the strike zone, given the Fed's forecasts. And at the margin, it looks like core PCE inflation will come in very, very soft, soft 0.2 in August, despite all of this tariff stuff. And cyclical areas of the economy remain very sluggish, notably housing, but also manufacturing. So, to me, there's a good case for going big. At the same time, the hawks can argue the economy is evolving in line with their expectations. Stocks are at highs, credit spreads are tight. What's the reason to go big? So I think that's the debate. And, just saying we should go 50, we should go 50, we should go 50, like that isn't going to get the job done. The question is like, how do you finagle this in a way where you can kind of, compromise to a good outcome? And, maybe that's not possible. I mean, maybe all you get is 25 and the dots show another 25 later this year. I think the markets probably would sell off on that news. I mean, I would just tell our listeners that I think it's going to be very, very challenging for the Fed to deliver what's embedded in market pricing, right? Like the market thinks the Fed's going to be at neutral 2 years before the Fed itself sees itself at neutral. Okay, and remember in June, the Fed actually revised up its 2026 rates estimate. Okay, so it's a pretty large gap between the two, between the markets and the Fed. And I mean, I just think it's a tall order.
Jeff,
right?
what are you hearing from the markets? That's a good segue. Thank you, Neil.
I think if you listen to the markets, I think the rate cut is a question mark. To Neil's point, you've got stocks at an all-time high. You've got the cyclical areas of the market leading. Long bonds are coming in, yields are coming in. Credit spreads are in a good spot. Financials are off and on leadership. They might not be number one, but they're in the top the top 50th percentile in the U.S. and broadly globally, right? So that speaks to kind of the global bull market that we have, and EM frontier markets, developed markets, with maybe the exception of Europe, all look to be in a pretty good spot. So I think it's the message from the market is things are decent, and how much do we need? Obviously Neil focuses on labor and some of the things underneath the surface, and there's no doubt that areas like home building were weaker. They've actually picked up, with the anticipation of the Fed cutting rates. But things seem to be in a pretty good spot. Maybe the bigger question is how do we think about gold? Is gold telling us that if the Fed goes, they're just going to keep this kind of persistent inflation bid to the market? Maybe that's there. I mean, if you look at the 5-year forwards in terms of inflation expectations, they're running, I don't know, somewhere around 230 to 220, something like that, 220 basis points out 5 years from now for the next 5 years. So that's not wildly off the mark. So I don't know. I mean, to me, the liquidity in the system seems to be pretty decent and is reflective of that. Now, one thing that we could bring up, which is Howard's point, Howard Mason here at RenMac handles the internal plumbing of what's going on with the central banks, and he's at the point where he's talking about reserves getting into that kind of lowest level that they feel comfortable with. The Fed does in an ample regime environment, right? So the whole QT thing is going to start to soften, and we're probably in a more stable balance sheet regime. We'll see. He's more concerned about the supply on the back end, but we'll see. We'll see what happens. I will be the first one to tell you that if you told me 2 or 3 years ago that rates would be, close to 5% on the 10-year, and then asked me where stocks would be, which is why I listen to the market versus tell the market what it should be doing, I would have said equities are going to be, in a world of hurt. And clearly that has not been the case. So the market's been remarkably resilient to these higher rates than I ever would have expected, given whatever 10, 12 years of financial repression and artificially low rates. The market's been ridiculously well behaved, given that boost in rates.
Do you look at
but rates have been falling?
Well, no,
lately.
Right in the near term, right? But I'm saying from where we were in 2022, right, to where we are today, that's been I've been shocked at how well the markets have been able to absorb that.
Like the recent move in the stock market, is that what is that like? That's a function primarily of the markets betting on the Fed.
I mean, I think some of that.
Rates have come down a lot, and the 10 years at 4%.
Oh, are you talking about bonds? Or are you talking about equities?
Both. Presumably, right? Like, I guess the thing is, if rates fall this quickly, like longer term interest rates fall this quickly, right? Like we were basically at, I'm just pulling it up on my Bloomberg right now.
475.
We were at 460 in May, and now we're at 405. So we've fallen 55 basis points in a matter of months.
Yeah.
Like lower risk-free rates help stock prices go up, all else equal.
Yes.
Right. And so I guess so at some level, like lower interest rates are one reason why stocks have gone up.
Oh, no, yeah, no doubt about it. But what I would say, Neil, the difference is if you look at the composition of what's worked, it hasn't really shifted, right? So what I worry about is, do we start? This is a great example contemporaneously. If yields are coming down and we're flipping from, say, discretionary names to staples, or from cyclical names to defensive names, then that's a message that, hey, the economy is weaker, we've got a problem, stocks are discounting that. Right now, what we've seen is kind of what was working continues to work, maybe with a little bit more gusto, but we haven't really seen a mix shift, if you will, in terms of what's been working and how, right? So I worry about that, which is why we always watch for that rotation. I worry about what is that message of the rotation, and as yields have come in, with the exception of really homebuilders, who obviously have done well, we haven't really seen any mix shift that jumps out to me as being like, aha, that's either that's a problem or that's more affirmation. In fact, if anything, I would say it's better affirmation, because we've seen a relative strength breakout in discretionary names, and that tends to be good news. Obviously, that is policy related and rate related, but you're seeing it in home builders. And I think, interestingly, and I have not dug into this, but what we're seeing globally in autos is amazing. Subaru and Suzuki and Toyota, and a few of them in Europe look good. So there's been an underlying bid to kind of traditional auto manufacturers, with the exception of BYD in China, which actually looks weak. So there's a curveball. That's been one of the stronger ones, and now it's actually the Japanese and some of the U.S. auto manufacturers.
That's a lot for you to say, being a Michigan guy.
Yeah, I don't like autos. Auto? You'll never get me to buy an auto, but that said, they look good. It's for other people. I report the facts, Steve.
I mean, I would just say that if I had to put an economic take on it, the most obvious explanation for what's going on in the markets is basically the president is right that we're in a golden age. That's the only way to really describe it, right? Because, so hear me out. Stocks are at records. Stocks are at records. Even though the Fed is cutting more aggressively, inflation expectations aren't moving. I mean, you heard Jeff say inflation expectations are right there. So the Fed's cutting more, nothing's happening to inflation. The only thing that explains that is a productivity-driven boom. Okay? So you're basically betting, I mean, if you're an equity investor, you're betting on a big boom in productivity, because that's like the release valve. That's what gets you strong real growth. That's what takes pressure off inflation, and that's what keeps bond yields and inflation anchored. So, we'll see. But I think if I were to, take a different side of this, I mean, at the end of the day, not like the signal from the job data is basically nominal GDP growth, like running barely at 3%. And so then you have to ask yourself, like, okay, like the stock market is up based on an expectation of earnings of, like, I don't know, like double digits. So can you get double digit earnings growth with 3% nominal GDP? And the only way that that's really possible is if productivity is just blowing it out the water.
What, Neil? Where's the if you decompose the jobs data, where's the underlying weakness and strength, for that matter?
Well, the payroll diffusion index is below 50, so most of the industries are actually shedding jobs. But the weakness has been in manufacturing and construction lately. You've seen it in, like, white collar professional work has been soft. Government has obviously been weak, particularly the federal and now state governments are soft. But it's the weakness is fairly widespread.
And all of this is happening with the backdrop of tariffs, right? And Steve, I don't know where we are with that at this point. I don't know if we got more on the horizon or what, but we're talking about equities at all-time highs and yields where they are, and et cetera, et cetera. And we're in a stage where most people, when this started, most, academic economists would have told you that, it's like Smoot-Hawley and, we're going to go into a recession.
Well, we had a few developments in the tariff front this week. I would call them all positive. I think the Supreme Court is they agreed to hear the case with respect to the president's authority under IEEPA the first week in November, which raises the possibility that they'll have a decision by the end of the year. Again, I think when you think about tariffs, the big thing to take away, and I think that's what's been taken away, is that they're going to be here to stay, whether it's IEEPA or not. The president would just use other authorities. I think in terms of more positive developments, the president suggested that he is very optimistic about reaching a resolution here with India in the coming weeks. We've mentioned that, that could be the sidelines here of the upcoming UN General Assembly meeting at the end of the month. So that was, I think, positive. The other thing that I think was very positive is report this morning that Treasury Secretary Bessent will be traveling to Spain to meet with some Chinese counterparts next week to discuss trade, as well as the TikTok ban scheduled to take effect Wednesday. What's surprised, we see another delay in that with respect to TikTok. But, Bessent's meeting will come after Secretary of State Marco Rubio and War Secretary Pete Hegseth had the conversations with their Chinese counterparts this week. And that's really important because we need these lower level discussions as a precondition for an eventual leader level meeting between Trump and Xi. And the opportunity for that might be October 31st, November 1st. That's at the APEC summit in South Korea. And you really need a leader level decision here on a way forward. And we say talking is better than not talking. Do I think they're going to make some massive agreement ahead of the November 10th deadline for the reciprocal tariffs to come back into effect? No. Do I think there'd be some positive momentum to sort of grant a further extension to maybe try to find an opportunity to create a deal moving forward? Yes. So at least from a tariff standpoint, I think those are relatively good developments.
Let's get to the mailbag. Harry, good morning. Just as a reminder to everybody out there, send in your questions. You can send in questions on our social media posts. We post those, things for you guys to put in questions, and we'll send you a hat. But you can also send it to us at RenMac.com. for the hats. We got nice trucker hats. We're running out of them though, and so we got new ones coming. So get them the vintage ones while you can.
We've got the audio and visual, right? So let's get people's faces on this thing.
Yeah. So we don't have to be.
Yeah, exactly. I mean, it's good to see Harry.
We'll keep you on here, Harry, though, as a face, because it's part of the show. But give us what you got.
Okay. Good morning, everybody. So today we have the question from Farnum Brown. His question is: Neil argued market don't always lead the economy, particularly in period of stress, citing rising stocks with Fed rate cuts in 2007. Could markets be mistaken now? And what does Jeff make of this possibility? Thank you very much.
So it's the old disconnect between economics and the market. So can the market be wrong? So I always say the market can fib, but it doesn't lie, and it certainly doesn't get away with it. So it can certainly lead you astray at times. I think the worst time to be a market technician, or one who, let me rephrase that, one who listens to the market, and it's Zen-like attributes. I think the risk there is when you have a externality like a COVID or maybe even tariffs that have to be repriced very, very quickly. That's tricky. It's tricky from the economic side of the ball. It's tricky from the market side of the ball, because it is changing things very dramatically and then trying to discount those from the officially the future cash flow of what that looks like, and that becomes a very tricky game. So that's pretty obvious. Is this a point where that's that there's risk of that? There's always risk of that. One of the ways that we try to mitigate that risk is by looking at the weight of the evidence of a lot of different things, right? So instead of just looking at, say, the S&P or bond yields or any of that, we try to dig down into what's going on and then look at those relationships historically. And one that we mentioned before is the cyclicals outpacing the defensive names, right? And that's important because that implies that that part of the market's not seeing a problem with aggregate demand as we look out the next 6 to 12 months. Now, you have to be careful with that too, right? Because if you don't deconstruct it, you might have the Amazon effect, right? So Amazon is a huge market cap, and that could dominate what the data tells you or what the price data tells you. So we look at it equal weight, right? And there's a lot of different things that we do to try to, again, get to the essence of what the markets are telling us and what that implies. And what I would say is that weight of the evidence, none of them being necessarily more important than the others, but between credit spreads and the action of financials and the cyclicals versus defensives and all those things put together, we're pretty comfortable with the state of progress and what the end numbers are going to look like. Again, there'll be pockets of weakness, and home builders might be one of them. But what we're seeing right now is actually still pretty affirmative to the bull case. I would say that this is not a momentum market, with the exception of maybe Oracle. This is more of a trend market, and what that generally means is that you don't have to chase things that are gapping higher. You can be patient. Things will consolidate. They'll come in, but I think good things are happening. And you can also look at, I'll just circle the wagons here on this one on China, right? We talked about China for a long time on this pod and the improvement there. Some really big breakouts. Alibaba with a big breakout this week, looking great. So there are good things going on globally, and we'd kind of be the outlier here if that were a problem. So we're still bullish. Thank you, Farnum. Always good to hear from you.
Farnum's a longtime client of RenMac. So Farnum, we got a new hat coming for you. Thank you for that. Neil, what are you watching next week?
Yeah, so I mean, on the Farnum question, I mean, he's asked me that one before.
We'll still send him a hat.
Yeah, I would just say that, look, I mean, markets are a good discounting mechanism, but they're not a perfect discounting mechanism, right? And I mean, it's not unusual to see the market gapping out to new highs as we're betting on cuts. I mean, that's not ahistorical, right? Usually the markets rally after the initial cut. Then people start to think about why the Fed is cutting, and then you can get potential problems.
I'd say too that there have to be enough inefficiencies to keep people coming back to play the game.
Well, I would just, I mean, the one thing I would say before I just say what's on next week is that, you can't, I mean, I don't know, like you've never had really soft landing cuts twice. In any cycle, you've never had soft landing cuts twice. We had the soft landing cuts last year, and we're about to get some cuts now, and you have to ask yourself whether you can have soft landing cuts twice. I would just say that the Fed was proactive last year. They're more reactive this year, so that creates a little bit more tension in the economy. But for next week, we have retail sales. Remember, auto sales slid in August a little bit, so that could take some pressure off the headline. Remember, these are nominal numbers, so the fact that core goods, particularly car prices, rose, that can kind of fudge with the data a little bit. We saw an uptick in apparel prices as well, so some of that tariff-related pressure is sort of showing through. Tariffs on Switzerland put upward pressure on jewelry and watches and things like that. So, you have to kind of think about the price effects when you look at these retail sales numbers. So, to the extent that the number looks good on the surface, you kind of have to back out what the inflation effects are. We'll also be getting data on manufacturing production. I've had a lot of people talk to me about how the ISM New Orders Index rose, but ISM is 300 people. The jobs data are thousands of establishments, and the work week and employment in manufacturing is very weak, which is why the consensus is looking for an outright contraction in factory production next week. So I think that's important, and we're going to get data on housing, multifamily has been a big driver for starts lately. I think that probably unwinds. And and we get the Fed, so we'll see a lot of data to chew on next week.
Steve, who's knitting it Lions have this week?
Villanova, streak of unremarkable opening games this season. We'll find out what they're really made of when Oregon comes to town at the end of September.
Well, just be careful with Nova. As we remind you, they got a pope now, so they got the Lord on their side.
Well, with the way Drew Aller played last weekend at Penn State, I'm not putting anything past him. But
so, what else you got?
Number 2 in the country, and he's complaining. It's unbelievable. I mean,
it's crazy.
The key to happiness is low expectations.
That's what my wife says.
Their expectations are high at Penn State. So
I'll tell where other places are high. I was in Texas this past week, and all the talk about UT and Arch Manning and the whole thing. That's crazy, and Sark's on the hot seat down there. He doesn't turn it around quick.
Overrated. Clap, 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 clap.
It was pretty unremarkable what I saw against Ohio State. But anyway.
You know what though? It is still a very expensive ticket to get into those UT games. I mean, to get in the door, you're like $400.
Yeah, well, that's one of the reasons they have one of the larger NILs. I think best team money can buy. We'll find out whether or not that's the case. But
you have to return all those Lamborghinis. Yeah. What do you got for us?
Well, I mean, I think we hit on the two big things. Mainly, can House Republicans move this stopgap measure and really shift the ball to Senate Democrats? I think that's the thing to watch with respect to the shutdown. And then on tariffs, this meeting between Bessa and his Chinese counterparts in Spain. I mean, that's sort of the big thing to watch. One thing to keep in mind, sort of under the radar, that I saw another positive development on the tariff front is Mexico actually imposing 50% tariffs on Chinese EVs. Maybe that explained sort of what Jeff was talking about with the BYD move. For me, I looked at as maybe moving closer to the U.S. and trying to fortify this American bloc. We have this October deadline where tariffs are supposed to increase from 25% to 35% on Mexico. I've seen a lot of positive developments there, so I think the conversation will be less about will they increase them, maybe will they roll them back. So I think that's sort of moving in the right direction on the neighboring tariff front.
Jeff?
Yeah, I'll be looking for a rotation, very similar to what Neil was talking about and what Farnham was hitting on, right? So do we have a a mix shift going on, and what are the implications of that? So, probably the best candidate from the defensive side would be on the healthcare side. Very, very oversold. Really, people are just despondent in that part of the tape, and so that'll be an interesting spot. If this were a contrarian podcast, we'd be talking about healthcare. But there's not a lot of momentum there, so that's not a big call from us. But certainly, as we get into the end of the year, we're looking at that as a possibility for just some type of mean reversion. If that's a signal or not, we'll see. But the utilities, which are defensive, still look pretty good to us. A lot of them have consolidated and pulled back, but they're still underperforming what we're seeing from the more cyclical side of the ledger. So we'll continue to watch that. Some weakness in machinery, so that'll be an important spot. So it's really just kind of trying to digest what the market's telling us and see in aggregate if there's a problem or not. So far, we're not seeing it, but certainly keeping our ear to the track, as they say, and hopefully the train doesn't come while we're doing it.
As they say about a lot of things, sometimes you just got to shut the whatever up and listen, which is what you do very well with your thoughts around the market. So why don't we wrap it there? I'd remind everybody, follow us on X, follow us on social media, follow us on YouTube. Make sure you're liking us and putting those comments in there. If you like what you hear on this pod, reach out to renmacaccess.com for more information. We do a lot of stuff here, not just this pod. So we'd love to get you on a trial, see what else we do here.
I'd rather hear what they don't like. That's even more fun.
Yeah, that is true. Well, yeah, we get a lot. We know what they don't like.
That's more fun.
That is more fun. But keep the comments coming, whatever they are. Like
free speech and the ability to turn it off too, right? You don't have to listen. You don't have to listen.
Right. And we'll view it as constructive criticism. It'll just make us better. We got better mics now because people told us I didn't like the mics.
That was a disaster.
It was a disaster. Now we think we got a podcast room for Jeff. So there you go. All right, we'll be back next week when we'll be 1 week older, 1 week wiser. I'm Steve Dutton.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
Thanks, everybody. Have a great week.
So long.